I guess we can get started now. My name is Elise Rosemary, and I am a vice president here at AKAM. Thank you so much for joining us tonight for the good, the bad, and the breaks. Nice tax overview for 2021. So I'd love to welcome our esteemed colleagues here tonight. We have Sherman Beer, who is a partner at Czarnowski Beer. Stephen is the senior managing partner at Czarnowski Beer. He serves an extensive clientele of over 200 buildings, providing enhanced services such as auditing, long-term budgeting, and refinancing. As a member of the New York State Society of Certified Public Accountants, he has served on several committees related to real estate issues, including the Queensborough President's Task Force on Cooperatives and Condominiums. Thank you, Stephen, for joining us tonight. We also have Stan Russo. Stan Russo has been a property tax specialist for 15 years with a law firm, Sonnenschein, I hope I'm pronouncing that right, Sherman Deutsch. That's a hard one. He handles their tax cert division, which comprises approximately 1,000 properties. He also handles cooperatives and condominiums as private clients for tax cert accounting and consulting. Thank you, Stan. We appreciate you joining us tonight. And last but not least, certainly not least, we have our own Meagan Mooney from AKAM. Meagan is the Vice President of Finance for AKAM, responsible for overseeing the accounting and the financing departments. She ensures all internal financial operations are running optimally and providing accurate, immediate, finance-related services, information, and responsiveness to all our client boards. Thank you, Meagan, for joining us tonight. So we are going to get started. This is obviously a very important topic, and we are so appreciative because this is tax season and these fine folks have made time. So Meagan is going to discuss our overview and what is going to be the topics of conversation. So I'll throw it over to Meagan. Thank you.
Thanks, Elise. Yes, welcome. And tonight we're just going to be discussing the following topics. We're going to be discussing the relevant real estate tax classes. There's a few, but we're going to pretty much stick to the condo and co-op world. We'll discuss condo versus co-op taxes, how taxes are calculated and paid. This is all for property taxes. The 2021 tax assessments, they were recently released. We're going to discuss some of that. RPIEs. Pied-a-terre taxes, we're going to discuss what it is, what are some potential nuances of this potential issue, and some future projections will be discussed. And then we're going to just take some questions at the end.
Great, thank you. All right, so now we're going to start to talk about our 2021 real estate tax overview. I believe Stan and Stephen are going to take it from here.
So I guess I'll start with the real estate tax classes. There are currently 4 tax classes in New York City. The first 2, tax class 1 and tax class 3, are really not applicable here. Tax class 1 is for houses, and they don't really get managed by management companies. Tax class 3 are for utility properties, and they're mostly government run. The 2 relevant tax classes are tax class 2, which is designated as residential, and tax class 4, which is designated as commercial. A lot of times you'll have a cooperative or a condominium with both commercial space and residential space. The differentiating factor is the square footage. So if you have, for instance, a 100,000 square foot cooperative with 10,000 square feet of commercial space and 90,000 square feet of residential space, that would be designated a tax class 2 residential property. Conversely, if you have a condominium, the condominium lots are segregated, so the commercial lot in a condominium would be designated as tax class 4, and the residential lots would be designated as tax class 2.
So when we look at the taxation of the entities that we believe most everybody's going to be interested in are co-ops and condominiums, there's some big differences. They both start with the city taking the market value of the entire building, but the difference is that the cooperative, the entire bill goes to one corporation, generally one block and lot, and on the condominiums, it's broken up between all the different units to the different unit owners. So the big distinction is that in the condominium, the person is paying their own real estate taxes outside of the entity, but on the cooperative, the whole building is paying, and then it's included in the monthly charges. To get reductions in the valuations that the city uses, it's best to hire a firm such as Stan's to do the work for the entire condominium. That keeps the cost down to all the unit owners and gets much more economics of scale, approaching the whole building at once and not doing each separate. Those are the big differences between the cooperative and condo real estate taxes.
Meagan, can you tell us a little bit about how real estate taxes are paid?
Of course. As Stephen said, the co-ops will be paying for the entire building, and condo units pay their own. You can either pay through your mortgage company that might escrow something on behalf of the owner to pay that, or they can pay directly. The frequency depends on your assessed value. There are properties that pay either semi-annually or quarterly, and the city runs on a fiscal year, July to June. So the quarters are July, October, January, and April. And when it's quarterly, you can pay by the 15th of the month. If you're semi-annually, it's July 1st and January 1st. So that's the frequency of how they're paid. The escrow will either be through the lender, or we do take care of many of them on behalf of our co-op clients. We basically, you'll take what you need for the year and divide by 12. That's how you would get your monthly escrow that we put aside for you. We just want to make sure that you have the money there when you need it. So we keep that money segregated. I think that's it on how they're paid.
Great. And Stan, can you tell us how real estate taxes are calculated?
Sure. Real estate taxes are calculated based on a very simple yet complex equation. Every single year, a building is going to get an assessment, and that's the assessed value. Taxes are not paid on that assessed value. They're paid on what's known as a transitional value or a rolling average. That takes into the account the current assessment plus the prior 4 assessments added together divided by 5. That number, that average known as the transitional, is multiplied by the tax rate to come up with gross taxes. There is one caveat. You actually pay on the lower of the actual versus the transitional. And this is the year that is coming into play, because a lot of assessments have gone well below what they were in prior years because of the pandemic. So if your actual assessment came in at 1.2 million, but your transitional, that 5-year average, which includes the 1.2 million, is 1.3 million, you would pay on 1.2 million times the tax rate to get the gross tax.
Oh, that's interesting. All right, so now for the real estate tax assessment, Stan, how are the 2021 tax assessments made?
So for cooperatives and condominiums, by statute, they must be assessed as if they were rental properties. Since they're not rental properties, they have to be compared to rental buildings in the city. And this is where the Department of Finance has within its purview to randomly select rental buildings, take their gross income, and apply that per square foot factor to the cooperative or condominium's square footage. That allows them to come up with I call fabricated, they call estimated income for the year, and then they go through their matrix of reasonable expense ratio to come up with the net divided by a capitalization rate, and then they come up with the assessment. The issue with comparables is that comparables are completely subjective. There is no such building throughout the city that is exactly identical, a rental building, to a cooperative. So it's a lot of opinion. And this is where tax cert comes into play. Your tax cert attorney will produce alternate rental comparables in order to try and get lower assessments using that lower income. And I think I just jumped to the next tagline of how to protest these assessments. But assessments are made through rental comparables and their gross income, including them as like buildings, and you challenge them by offering alternate rental buildings with lower gross income.
Great. I think that's a very popular question, right? How do you protest? And then can you just tell us a little bit, for those who don't know, what are RPIEs? And then can you just go into the details for how they can lower tax rates, what have you? Stan, I'm going to aim it at you.
So an RPIE is a real property income and expense statement. For rental buildings, it's automatically required that they file an RPIE electronically each year. This is the foundation and basis for all assessments for the following tax year. So generally, the RPIEs are due approximately June 1st or 2nd in a normal year. That information from the rental buildings is what fosters the city to create the assessments for not only those rental buildings, but also for co-ops and condominiums. As a result, cooperatives and condominiums are technically, including rentals, they're technically 2 years behind the curve of income. So for the 2021/22 tax year, those assessments are based on the 2019 income, because that's the last full year by the due date. The problem with that is 2019 income was not affected by COVID. I was very surprised that the assessments landed where they were, because the city did have the opportunity to use those high rents and high income that occurred in 2019 pre-COVID.
So does that seem to be affecting people, you would say, more positively then in that case?
Yes, it appears that the city has taken the position that they're going to jump ahead and offer tax breaks as a result of this. However, one of the functions of taxes is the tax rate. When they come to their budget, they're going to be short. So they do have the opportunity to raise that tax rate. The problem with that is the tax rate is something that cannot be challenged by anybody. It's a mechanism for the city to balance their budget. So all of this lowering of assessments and values may be for naught if they have to raise the tax rate to make up the shortfall.
Interesting. I just want to take a minute really quick because I forgot to mention this, and I know everyone is going to probably have questions. And after we go through this presentation, we will be doing a question and answer period. So you can start preloading your questions now. And of course, if we don't get to them during this time, we'll get back to you. You can always email us at marketing@akam.com or any of these fine folks who are here tonight. So I just wanted to make mention because I'm sure this will bring a question. And then if we can just go back to the pied-a-terre tax. Stephen, can you tell us a little bit about the proposed pied-a-terre tax and maybe just tell people what that might be and give the overview?
So the state sort of looks out there and says, we've got all of this very valuable real estate. This type of a tax has worked elsewhere, like in places like Paris. And the concept is to try to capture money from the people who maintain places in New York as their part-time residents. It's gotten very, very hard to determine that this year because of COVID and people fleeing, having other places where they stayed. But conceptually, it's a proposal, so it has not become law yet. And they're trying to find a way for this threshold of about a $5 million value that there'll be a tax that they can charge. And it's relatively easy on the condominiums because there's a block and lot with the person to put the charge on who owns the unit. These are units that are second homes, not primary residence. For cooperatives, though, it's a little bit more complicated. We'll talk about that a little bit later, but conceptually, the same concept is about the trying to capture this tax. And it also would apply to private homes at much lower percentages than the annual rate to follow the annual rates for co-ops and condos, which here are the 10 to 13.5% in the proposals. Somewhere they came up with condominiums at $300,000 assessed value we're selling for $5 million. That may have changed with everything that's been going on. There's a default mechanism where you can go back and prove that the market value of your unit is below $5 million and get taken off of this. But conceptually, you have to do the work. So what we're seeing is that the state is going to work to identify as much here as they can. And I think they're going to try to default into putting the charges on to accounts and see what they can collect. And it's going to hit a lot more people than anybody realizes until it works itself out. There's limited information out there. We have some experience how the state operates when it tries to find this kind of money in New York City residents who have, let's say, apartments, either rentals or co-ops and condos, whether they file a New York State and city income tax return. And New York State income tax has a very strong system to try to find people who really probably qualify under the rules to pay New York State and city income tax. And they use a bunch of different mechanisms, which we've listed here on the slide. So they look and see what you're doing with your tax return. So one thing they're going to have, if you didn't file as a resident, they and you have this real estate that you own, they can line it up and say you are a non-resident, and they're probably going to just throw the tax. The other place they can look to see is, do people have other places outside of? The records are very strong. Some of us may, when we go to qualify for something with a lender or a bank, let's say, they ask a bunch of questions that are out in the public domain about ourselves to make sure we're us. So they've got all of that information to use to try to also work to identify the people and to put through the charges. And then lastly, they have, the state has the voter registration rolls, the motor vehicle rolls. If you have a car in New York, are you a resident? Are you a non-resident? And how that's all going to play into who they're going to charge and who they're not going to charge. So I thought it was important that we sort of just go over some of the stuff that they do to try to find the people and set up the taxes like this. So the condominium is very straightforward. You would get a charge with your real estate taxes if they determine that you were a non-resident owner. It's really easy to find that out. There's an abatement form that gets filled out, so they have the information there. They have tax returns, so it shouldn't be too hard, and that's a direct charge on the account. The real estate can't change hands if there are arrears on the account, so it's relatively comfortable way, short of having a petition from the owner that their unit is not worth $5 million. And then on the cooperative is where it gets a lot harder, and where some of the stuff I said before about identifying becomes important, is because you need a list or some kind of chargeback system to tell the cooperative who you charged, and that the cooperative has to go and charge it back to the owners in the units. To me, that's a very complicated thing. There's a lot of work that'll go into that. It'll be hard for cooperatives to potentially get this money back if they pay it. So all of these things are up in the air as this is hanging out there. The most recent estimates for the amount of revenue it'll raise drop substantially from the original. So that's a positive sign. Obviously, there are groups that are being motivated to try to come out and stop this. So we just wanted to make sure everybody was aware of it as part of the presentation.
Thank you. When do you have any idea? I mean, I know this has been proposed before, of the timing of which this would take place.
I haven't seen specifically, because I don't think it's gone that far, and I'm working off of what's out there in press releases and things like that. So it is somewhat limited. So we really don't have a time frame. Obviously, the state's looking for money as soon as possible. So, my guess is they're going to move this through, if it's going to happen, relatively swiftly.
It's a huge shift, I think, if that really does happen, especially the luxury market. So interesting.
I feel it's going to affect a lot of people. Yep.
Oh yeah, for sure. Okay, so for the future, because you guys are all, I think, have crystal balls, I believe, in the background. If you can all maybe just share a little bit about what you're seeing that might result into the future as a result of the pandemic. If you can each share a little bit of your thoughts, that would be great, because I think, you know, we've dealt with so much of the unknown already, but we do need to be strategic and plan ahead. So I guess we'll kick it off with Stan, and if you wouldn't mind.
Well, can everyone hear me?
Yes.
Okay. So the future is always easy to predict. And with the city, it's even easier because, again, they have the right to essentially do what they like within reason. But a lot of these assessments, specifically co-ops and condos, are based on opinion. That the issue is, how are they going to treat vacancies? And that's really the most important question. Are they going to approach vacancies in rental buildings as complete lack of income, or at some sort of subset of what the market rent would be? If they're going to treat it as a complete lack of income, then cooperative and condominium assessments are going to stay flat or go down. Conversely, if they treat vacancies as a subset of what you can get for the market, you're going to see assessments rise next year. And I think what's really going to dictate how the assessments trend is what the city council does with the tax rate. If they happen to raise the tax rate significantly and there is huge feedback, next year's assessments will jump dramatically, because they can justify those assessments being raised based on the fact that vacant rental units are not valueless. It is the future. We really just don't know what's in store. We can theorize. We can possibly predict. The one thing that has to be done is you have to get somebody on your team, a vendor who's going to fight for you and make sure that no matter where your assessments end up, you have someone aggressively going after the city, trying to reduce it to lower your tax base as much as possible.
Great. Do you have any idea? I mean, I know, again, we're asking a lot, but do you have any idea when they would make an announcement like that?
Well, the city's council usually meets sometime in the fall. This is obviously a different year, and with the tax rate going down and the assessments going down, I would say we should know something by summer. But prior to that, they're still collecting revenue from last year's taxes and last year's assessments, which did not jump down dramatically because that's very pre-COVID, or based on very pre-COVID information. So there is a little bit of a lull until July hits, where we're going to see our first impact of the reduction of assessments. I would say they're probably going to prepare for it sometime in the summer, and there will be an announcement late summer, early fall.
All right, thank you. And now, Stephen, it's your turn. Tell us the future. Uh-oh, the future has no sound. I think you have to unmute, Stephen.
Sorry. These valuations are a result of market rents. And with the exodus that happened specifically in Manhattan, there was a huge shift in rents. And so those calculations, already have made the effect that we're talking about. How that's going to play out and what's going to happen to the real estate market are really big questions that are out there. The drop is a phase-in drop, so it doesn't hit everything all at once. It affects the transitional. So that's part of it's going to take some time before you're going to write a smaller check, either for your condominium or your co-op is going to pay. So it's hard to say. That the good news is we seem to have a vaccine, and the stock market sure seems to think that we're going to come out of this and we're going to be back where we were before. I can only hope that that's what's going to continue for the real estate valuations in New York and ultimately the taxes.
Yeah, I think everyone's hopeful, but I think it definitely is probably going to take some time. And then Meagan, I know you have some jokes you want to tell, but if you want to give us some future, now's your time.
No, really just, it's more for the co-ops that we manage. We did budget conservatively. So all of these items that are coming down the road, I think we're we're pretty well covered for at least this year, because typically they don't even announce the tax rate until November. So we do probably have a good budget in place for those of you that are in co-ops. You really want jokes?
Yeah, why not? We're going to head into the Q&A. So if you want to tell us
Okay.
a tax joke, sure.
This one is really for Stephen.
Okay.
Okay. Where do down and out accountants go? Tax shelter.
Ah, good one. That was our halftime show. And
That's
now-
that's what I have in my future. Thank you.
I think that's enough for today.
That's good. All right. Thank you, Meagan. All right. So now we're going to open this up. I know that there's a lot of, questions that our clients would love to ask you all. So we're going to start with some of them, if you don't mind. So do you think, we kind of touched on this already, and do you think the process for protesting the assessed value is going to be shifted in any way due to the pandemic, or is it just status quo?
So the process remains the same. I think more to the point of the heart of that question is, how are the hearing officers going to respond to what's going on? I will tell you, last year, we didn't expect much in the line of what they did, and they actually took into account what was happening in 2020 on assessments that really had no basis or foundation from 2020 income. So we're hopeful that even though assessments did go down approximately 10% across the board, they're still going to use the same methodology, such as rental comparables, and those rental comparables income have reduced or have declined. So we're going to use that to try and move the needle even further.
Great. All right. So can you go through the pied-a-terre tax again? We have someone who's a little bit confused, and they just want to understand how it affects the co-op. If the unit in a co-op is valued over 500 million or 5 million rather, or is it valued over 300,000? They had a little bit of
So when Stan was explaining the assessment system, there is some value that the city uses, and then they multiply it for an assessment at 45% of that number. So somewhere this $300,000 turned into that's what units are worth that are $5 million value units. Some of the boroughs, that's not the case. You probably could be as low as $2 million at a $300,000 assessment. But conceptually, it's about the assessment being at the $300,000 level. But the opting out, the going back and protesting is my unit is not worth $5 million. So it is very confusing. So it's the assessment for the unit that the person's in the co-op is that $300,000. That's the type of complication that's going to be out there. How do you value the different units? Do you use the shares? How does the state have this information, and how do they present it to the cooperative board and the management to go and try to get it back? We don't have any of that right now.
Got it. Yeah, no, it sounds a little confusing, but I guess they have to just figure that's why it has not been, I guess, put out yet to the public. So it sounds like they got some stuff to figure out, but thank you for that, Stephen. What exactly is the process for protesting an assessed value? If you can just take us through the process.
Sure. So every year on January 15th, the new assessments are released. That's for the upcoming tax year, which begins July 1st and ends the following June 30th. There's then a 6-week period to file a document called an application. And that includes either a TC 101 for cooperatives or rental buildings, or a TC 109. And these are just the names of the forms for condominiums. You have to file that plus an income and expense statement to the city prior to March 1st in order to have an active protest on file. If you do not have an active protest filed by that time, you cannot reduce your assessment. That's the bottom line. But if you have something on file, it doesn't guarantee you a reduced assessment. It just guarantees you entry into attempting to reduce it.
All Thank you, Stan. Okay, so does anyone know, this might be a little bit out of the realm, but does anyone know the latest status on the city's green buildings taxes and then the fines that might be associated with that? Is there a schedule yet for this? They're aware of?
I'm not familiar with that at all.
Okay.
I think that's less of a valuation issue
Mhm.
and more of a tax on buildings, which is outside of property tax. So I'm really not familiar with that.
Got it.
And I think it goes out a ways before it's going to come in. You know, and so many things have to happen for there to be enough to collect that tax that I understand the interest, but it's still a long ways off. And I think it's going to change.
Mhm.
It's really a moving target.
Got it. All right. So ownership structure of many condos are structured as LLCs without disclosure of true ownership or location of owner. Do you anticipate that there will be disclosure requirements placed on condo boards to compel disclosure of that information? And are there any issues there with that?
No, absolutely not. This is not about who owns the unit. This is about the value of that unit. More specifically, if there are requirements for getting the primary residence abatement, I believe LLCs may not be eligible, but that's more of a management question. But as far as from a valuation perspective, it's irrelevant who owns it.
Got it. Okay, the 10% tax is on what? Someone would like to know. The person's currently allocated real estate tax in a co-op?
That's what I expect it's going to be. It's going to go towards what the tax on the unit is. So it's like a surcharge.
If I can add to that, Stephen and I have spoken about this. They're not going to add it to the property tax. They're going to have to separate it as something else on the property account for the cooperative or the individual units, which they have done in the past with emergency repairs or sign charges, but they definitively won't add it to the valuation because I think they're looking for something, if they implement this, that can't be challenged.
Okay. Is it possible so they want to know, is the pied-a-terre tax in addition to the real estate they're already paying on the unit, even though they're mostly living outside the city? Or
Yes, it would be.
Okay, so separate.
Yeah, I think they would be completely segregated taxes.
Okay. All right, so now focusing on the vacancy issue. What about the fact that landlords are offering free months in a year's lease and this overall affects the actual rental income for the building?
This is actually a really good question. We know that in 2020, there was a leniency issue regarding rents. How the city is going to look at that in terms of gross income is really unknown right now. The argument is that if there was a vacancy in a normal year, that rent or a market rent facsimile for that unit would be supplemented and maybe discounted by about 8 to 12%, depending on how many vacancies there were. This is uncharted waters. I would say they would probably treat it similarly, but if gross income for a random building went from 600,000 one year to 200,000 the next year, they're not going to use 200,000 to comp cooperatives. They're probably going to use somewhere closer to about 450. And that they're going to say is the best they can do because market rent is what the value of the unit is based on. And then they're going to discount it significantly.
All right, so now going back to the pied-a-terre tax, would the $5 million market value apply to co-ops and condos equilaterally, or is there a difference?
It's my understanding that's the level that they're shooting for. How that ties into a $300,000 assessment that's been placed in the information about the tax it's hard to totally follow. But it's my understanding that's what they're going for, units at $5 million or more.
Got it. And so now sticking with this topic, So in essence, does that mean that a property that has an assessed value of $10 million will have a property tax of $1 million per year at the tax of 10%? And if so, is that essentially saying that the apartment purchased, if assessed value is close to that purchase price, is then, Xing itself out? And how is that reasonable?
So the 10 million is an assessed value. So that's lower than the city's market value, which must be higher than that because it should be roughly the 0.45 factor applied to that market value to get down to the $10 million assessment. And then that's as the value as a rental property that is not what the unit potentially could sell for or its real market value in the market. There's got to be some kind of gap in there that they're using the $300,000 number. So I go back to, yes, there's $1 million in real estate taxes due roughly. The factor is maybe about 12, it's a factor of 0.12, but still the pied-a-terre tax goes on top of it. And it seems like that one's going to be subject to if it is not a principal residence.
Okay. Thank you. Is there an equity argument that living outside the city, that they're using fewer city services than when they used to live there? Again, going back to pied-a-terre, is there something that they're considering, as far as, I guess the question might be also just utilizing the city tax differently?
So I want to go to the way New York State taxes personal income, that they've come out and said that even in COVID, when people work remotely, they're working out there for their own convenience. It doesn't affect us. They are not allowing it to move to the convenience of the employer, let's say, that would be better for taxation for the person not living in the state. So this is somewhat similar, where the way they're structuring the tax from what we can see is whatever the unit's worth, if it's not a primary resident, there's this tax. So that unfortunately can't be made as an example. The best thing would be to get a valuation if it was below 5 million and go through that process when it becomes available to you.
So to be clear, pied-a-terre tax can also mean that it's an it also would be an investor unit potentially. Someone would like to know. So say they have a valid lease from a tenant, are they excluded from this, or is it just solely, and is it for second homes only, or is it also for an investor unit?
Dan, can you take that one?
I would think it would apply to investor units. I think that if a building had 100 units and 50 were primary residents and 50 were non-residents, regardless of how many investor units there were, those 50 would be subject.
Okay.
I think this is more about, and again, we know not as much as we'd like to know about
Right.
this. This is designed to, I don't want to say penalize, but for lack of a better word, penalize those who own property in New York City and are not primary residents. So they're adding an extra cost to that.
Mm-hmm. Yeah, and we understand this is moving, so we appreciate both you and Stephen for, I guess shedding light on as much as we can at this time. So what proportion of state taxes is represented by real estate taxes, and are they likely to use real estate taxes to help make up the shortfall in other sources?
Well, we're really talking about city taxes for New York City, the 5 boroughs, and the primary use for paying for schools, roads, police, firemen, city agencies are through real estate taxes. I believe it's somewhere in the neighborhood of 80 to 90% of the revenue they collect to pay for those essential functions. With the essential functions probably on the decline right now, specifically what it costs to run a school right now, or possible layoffs, those numbers may have shifted down, and the the resulting assessments lowered as well.
Okay, thank you. All right, so one person's building enjoys a 421A abatement and they have it for 5 more years. At the end of the abatement period, what would be the expected increase in assessed value, if you know?
So a 421A is a benefit for constructing and developing property. Depending on the type of 421A abatement, because there are a few of them, hypothetically, let's call it a 10-year 421A. In years 1 and 2, your taxes are almost zero. There's a minor tax for base year taxes. Then in years 3 and 4, what your assessment is, and that transitional determines how much you pay in taxes at a 20% clip. So it phases down from 0 to 20% to 40 to 60 to 80 to 100%. So essentially in year 11, you're paying on the full value of what your assessment would be. So technically, to answer that question, it's driven by a number of factors, notably where the assessments go to and what year your exemption is currently in. But when that exemption phases out, you'll be paying on the full transitional or actual amount of taxes.
Right, thank you. Commercial buildings have been hit worse by COVID. Do you think the city will move the tax burden from Midtown to the residential sector? Anyone?
So what I have heard was commercial properties on the average were decreased by about 15%, while residential properties went down about 7 to 8%, and then the average is 9 because there's more residential than commercial across the 5 boroughs. It's a difficult question because there are different tax rates. So I think that they're just trying to evaluate the mechanism in place over the next year. And we really don't know where they're going to end up the following year. But for commercial properties, they got the greatest decline on average.
Yeah, got hit. All right, so for now, I guess we're going back to the pied-a-terre tax question. Is there any potential for this valuation to change now and affect not just the 5 million range and up, but maybe the 1 to 4.99 bracket? Because obviously there's a ton more inventory in that range. Is there any way that you think the city might shift it at some point because they feel like, they want to collect more?
Anything's possible. This is pending proposal for legislation. We just don't know. So the risk is out there.
Yeah. All right. So we all recognize that there's a fair amount of, things that occur during the tax cert period and ultimately balancing the budget based upon city's expense, not revenue in. Do you have thoughts on modeling assumptions for general tax growth?
So prior to last year, we understood that rents were increasing, or gross income rather than rents were increasing at an alarming rate. And the reason why this was happening is there are 3 types of rental units in the city. There's rent controlled, rent stabilized, and fair market. They're currently valuing cooperatives based on a combination of the 3 rather than an average fair market rent. So even if fair market rents were to go down from, say, call it 5,000 to about 4,800, you still have those rent controlled and rent stabilized units that are paying very little, $300 to $400. When they're bought out and put into fair market, they go from 300 or 400 to 4,800, and you have giant swings in gross income. The problem with that is now everything is up in the air. So how do you model a budgetary system based on a COVID world? I would say it's building dependent on your cash reserves. I always know when I'm asked about projections, I say you want to increase the assessment by 5% based on the prior year, but how you dictate the tax rate to manipulate that assessment is based on whether you need to be conservative or liberal with your cash reserves. So it really depends on the building. If they have a huge amount of cash reserves, you can be less conservative about protecting yourself against what the future holds. If they're a little cash poor, you may have to be more conservative to protect themselves, because the one thing you don't want to do during budgeting season is create a number that is so different from what the number comes in that now you have to assess. Nobody likes a maintenance increase, but they hate assessments more.
Right, for sure. Okay, so someone's tax abatement starts fading out in 2021, and they want to know, when is a good time to start protesting the assessment, and how big of a reduction can they expect?
When they say tax abatement, they're referring to a 421A.
I imagine.
The time to protest the assessments was probably 10 years ago, but as soon as you can, because you're still being valued based on current market conditions of rental comparables. There's a very big difference between valuation or assessments and taxes. Taxes are a function of assessments minus exemptions, but valuations are based on the market conditions. So you may be overvalued during your abatement and you're not paying taxes on it, but if you don't challenge them and keep them very low, when your taxes start phasing in, you're going to start overpaying and you can't recoup that money. You can only go forward from when you start challenging. So all co-ops and condominiums should be challenging their valuation.
So how do you know if a condo's tax attorney, for example, is contesting the assessment using the right rental comp buildings? And I mean, are there certain things to look out as far as, appropriate buildings, and who identifies those similar buildings?
So it's a very interesting question. There is no such thing as a right rental building. The only right rental building to use is one that showcases less income than the ones the Department of Finance used. However, if you imagine the subject building on a map and draw concentric circles farther and farther away, there are a number of different components that the farther you get away from the subject building, the less that rental building is able to be viewed as a comparable. So if you have a subject building that was built in 1937 and had never been altered, you don't want to use a building from 1865. That's pretty much too far away. You can, but it's a detracting argument. Or a building with apartment sizes of 1,000 per square feet, you don't want to use buildings that have 300 square foot apartments, because the hearing officer will look at those and say, the arguments you're presenting for rental comparables, the buildings you're presenting don't come close to matching the subject building, so how could I buy this argument as that they're rental comparables? So it's a bit of a strategy, but you want to hit a couple of fine-tuned points, such as age, apartment size, proximity, if there's been alterations in the building, etc. And the closer you get to the building, the better the comparable looks for the argument for the hearing officer.
I just chime in.
Yeah.
In my experience in auditing the condominiums and the co-ops, they generally hire this type of a firm like Stan's every year, and this is taking place. So the board is monitoring the process along with talking to AKAM as far as, if that's the right way to go and things that are going on. All that is happening. It's just that you may not see it, that it's underneath everything that's going on. So you may just need to ask to be sure the process is going on, and that the board feels comfortable with who they're using.
I mean, I cut my chops by being ultra aggressive and fighting for clients, and I think that that's the correct way to go. Even though we handle about 1,000 clients, I look at it as we handle one client 1,000 different times. So every single client gets that personalized attention for their case, because every single case is different, every single building is different, and all of the variables surrounding it are different. So we have to really approach it as this client is getting 100% most aggressive methodology, because we really don't know who the hearing officer is going to be. And if you get the better hearing officer, you want to shoot for the moon on that one, but you wouldn't take, a Central Park co-op and compare it to buildings from Alphabet City, because then it would be a waste of time. But you want to find the best buildings with the lowest income to bolster your argument and act in the most aggressive manner.
Great, thank you. How will condominium units, so this is again going back to the pied-a-terre tax, does it matter if the unit is individually owned or if it's owned by a corporation or trust?
We answered that before, that we're seeing that it's going to be charged on that if there's no, if they believe it's not a principal person. So if it's a rental, or corporation owns it, it's probably going to get hit.
Got it. So now, again, with the pied-a-terre tax, does it matter if you're allowing your child to live there? Will that same, issue apply, or does it now fall into primary resident category?
If it's your primary resident, if you're it's primary. So if you're there with your child and it's your primary residence, then that should be the form that's filled out to say that's the case and that you should not be subject to it.
Got it. All right. Do you think? Yeah.
Sorry, I think this is also a way to try and prohibit owners from getting benefits in two separate jurisdictions. So if they owned, if two parents had two units, and one they let their child who was of age live in, but they lived in the other one of them should be subject to this pied-a-terre tax because they're the owning people. So they don't want them to get the benefits on both sides. Now, the easy solution would be to transfer it to the other person, and that alleviates that problem.
Got it. Yeah, I think this is a very interesting topic, and because it's moving so much, people really have a lot of questions about it. So another thing that people are concerned about, or do you think that shareholders, the board has to answer to their shareholders, do you think that their shareholders will understand what an assessed value is? Because some people are concerned that, they'll say, well, my apartment can't be sold for $5 million, so the tax shouldn't apply to me. So they're just understanding as a board member, how to explain this to their shareholders. And if you have any suggestions, they appreciate that.
So again, it's pending legislation. It hasn't come down. And it's a very difficult place to be. The way it's going to work is the co-op's going to be the one to be delivering the bad news, short of there's some kind of communication that goes directly to the unit owner from the state. And there's going to be an education process. There's going to be unhappy feelings. These things happen when something like this is done. It's an easier way to collect the money on the state side, and that's where it's coming from. So
yeah, it's a moving target. So based upon rental market conditions, do co-op boards need to be concerned about the impact of a proposed capital improvement campaign?
I understand what the question says. I don't understand what it means.
Okay. I guess as a follow-up to that, does the Department of Finance speak to the Department of Buildings to see if those permits would trigger a set example or representative set? I'm not exactly 100% sure.
Yeah, again, not really following. I will tell you this. Rental buildings are allowed to use capital improvements to lower their net, and it's a bolstering argument in tax cert. And about 12 to 15 years ago, the boss at my firm stood up and asked the president of the tax commission, why can't co-ops and condos do that? And the president of the tax commission said they absolutely can. And since then, we've been including the depreciation schedule or fixed asset report, capital improvement schedule for both co-ops and condominiums, and trying to use that as an additional bolstering argument to move the needle, sometimes taking a mediocre case into one that is deserving of an offer, or at least anything to get the hearing officer to see their way fit to make a reduction. So for that amount, I would argue, and I know that there are GAAP rules and guidelines, I would argue that every single thing that can be capitalized for a cooperative or a condominium, not so much for a condominium, but for a cooperative, should be capitalized, because anything that's in just base repair and maintenance isn't counted anyway. It's used as an expense ratio, essentially. But capital improvements are really where you can take an expense ratio of 30% and move the needle to 32, 33%. And while it doesn't seem like much, that's hundreds of thousands of dollars potentially in assessment reductions that take a case where it's no offer into possibly an offer.
I think that you answered the question, by the way. So good job. All right. So again, because everyone loves this pied-a-terre tax, maybe not.
This is easily the big winner, and I think I talked more in the beginning, and now Stephen has the floor.
So, is there what people want to know? Is there any way to fight this? Is there any place that they can, voice their opinion? Any ideas on that?
Well, you always have, your local politicians to complain to. I really didn't prepare to see what organizations are out there coming up against it, but there's information available. I would say do a search and contact your state politicians. And, grassroots, this was pushed off once before. They didn't do it in 2019 and they went with the mansion tax, but this came back again starting this year. So I'm all for it. It's really a nightmare, and there's probably not a lot of money there. And maybe when everybody says what they need to say, they're not going to do it after all. So maybe it'll get lost again.
Yeah. And so someone says that you should contact Revenue, because as a follow-up to that too. But yeah, this has happened before. So, and I guess we will finish it off with this one. And as a reminder to everyone, if we did not answer all of your questions, please feel free to email us here at marketing@AKAM, or of course, at the end of today, we're going to provide you with Stephen, Stan, and Meagan's email. So you can always reach out to them directly as well. So just to finish this up, how often are the assessed values lowered when they're protested?
I thought the future question was the hardest one I got, but this is by far the hardest one. Again, it's building specific. I can argue that we filed close to 1,000 applications last year. We asked for about 800 hearings and got about 200 reductions, but that doesn't mean anything, because on those 200 buildings, they were all deserving of a reduction, and on the other 600, maybe 10 to 20% probably should have gotten a reduction, and the others were just trying to move the needle to see if anything happens. So there's no success rate other than, are you successful each year for each building? But to better answer the question, the tax commission gets about 60,000 applications per year, and I think last year they made 8,000 offers were accepted. And that's 2019. The tax commission is still in the process of making offers for 2020 because of what happened. They were so far behind. They've done a really good job this year, though. I will say, based on, I know technically you want to see them as the enemy because they're the city, but they're the ones lowering the assessments, and they have put together a methodology for not having to go into the city and meeting with people, but still allowing people to make arguments on cases. And they've made a significant amount of offers, but they still have about 5,000 buildings and properties to get to over the next 2 or 3 weeks.
Gonna be very busy, just like you.
I'd like to just add that there's a minimal filing fee. Generally, we're seeing it happening on all of the properties. And, it's my understanding that the fees only come if there's a win. So there's no downside to filing. And so just keep that in mind.
Very helpful, Stephen. Thank you. So, I really can't thank you enough for participating. I know this is extremely, extremely busy times for all of you. And thank you for taking time out of your evening to inform us on all these upcoming changes in the tax brackets that we're all in. So thank you, Stephen and Stan and Meagan, and everyone's email and information is here. You can feel free to contact them directly. We also have recorded this, so we will be able to share this information with you all and your board members if you're not able to. Well, obviously you're here watching us, but if your fellow board members were not able to attend. So thank you all for joining us, and have a very safe and happy evening. Thank you so much. Have a great night. Bye-bye.
Health and safety to everybody.
Right.
Stay safe.
Stay safe. Thank you. Bye.